All right, welcome to this week's episode of Unusual Profits. I am your host, Michael Gridley. I am super excited to be back this week. For those of you that are new listeners, this is a podcast about niche businesses, the people that work in them and how they make money. And I am the world's number one nerd of people who like niche businesses and love talking about them. So I am super excited to welcome today's guest, who's Morgan Weber out of Houston, who I think is our first guest who has a more varied background than I have, doing everything from farming to California to right-of-ways. And it's super cool to dig into the business that they're part of and founded a few years ago. So Morgan, welcome to the show today. I'm super glad you're here.
Man, thanks, Michael, for having me on. It's always fun to get in and nerd out about stuff like this.
Yeah. Well, I'm so glad you're here, and also thank you for dealing with all the technical difficulties that we had so far.
It doesn't help that I'm easily the most technologically challenged human that might own a lot of technological devices.
Yeah. Well, so we'll get there. It's going to be great. Yeah. So y'all's business is called Agricole Hospitality, based out of Houston. Tell me what the business does. What do you guys do?
Yeah, I mean, we're a small independent restaurant group. We have 6 restaurants in our group. We started the first one 10 years ago. Grew very, very organically. You know, we got started. We had no. We weren't looking down the barrel of a huge future in developing this kind of restaurant group as it might be. I come to it from a very peculiar stance, as you know, most either chefs or bartenders, you know, they and even restaurant owners get into this game because they got into it early. They started cooking in high school or working in restaurants in college, and I did none of that. I went to Baylor University in Waco and have a degree in music that I don't really use. In school, you know, my parents thought I was super ADD, and what I've realized over the last 15 or 20 years is that I'm not really ADD. I'm super like OCD and hyperly focused on subjects that interest me and that I'm passionate about.
Yeah.
When I left school, I had no clue what I wanted to do outside of knowing what I didn't want to do, and I didn't want to do anything in the music business. I was not a terribly strong performer. I had a lot of performance anxiety and all that, and I knew that a life of that just was not gonna suit me. So I got a job that my dad helped me get, acquiring property through eminent domain processes in Houston. And really didn't like that, but still had no clue what the long-term future was going to look like. So I parlayed whatever experience I had in that company to land a job with the Metropolitan Transit Authority in Houston. They had a massive light rail expansion program going on, and I came on there to manage the real estate acquisition of 2 of their light rail expansion lines. It was very interesting to me. I was surrounded by experts in that particular field, whether it was the appraisal process, legal process, and it was just around. I was immersed in high quality experts that were experts in what they did, and that was really impressive to me, to find people that could just own a subject, whatever that was, and that even though I didn't really care about the subject matter, it appealed to the way my brain works. Mm-hmm. So I did that for a few years. Got our project with Metro at that point was very fragile. The city of Houston did not want it. The landowners didn't want it. And it was Metro just trying to push this down everybody's throat. So the project ended up getting paused, and I found myself truly without a job. So at the same time, my family has always been a family of really great cooks. My grandmother, tended a massive vegetable garden that my mom grew up with, and she did that until she was basically too old to not. She died at like 94 years old, so she did it a very, very long time. But she possessed a skill set, my grandmother did, that we have kind of lost. It's not something that the generation after her and then my generation has really picked the ball up on. And the general idea is that to be completely like a self-sustaining family, they lived out in the country. And she possessed this crazy, amazing skill set that you could plant a massive garden. You would do succession plantings of seeds. So if you were going to plant corn for the summer, you wouldn't plant all of those corn seeds at the same time. You would space them out over the course of weeks so that all of the crop didn't just come together at the same time.
Yeah.
And you had an overabundance. So a family that preserved vegetables, pickled things, it was a really cool environment to grow up around. So I had that kind of intrinsically built into my system. And when I got into college, I started really getting into food. I grew up not a very good eater. I was a pretty picky eater, but really got like all that background just got wiped away. And I was just like, I want to try everything. I want to eat everything. I want to taste everything. And then that inherently led to an interest in booze and how booze is made. And, this was the mid 2000s and there wasn't like everybody was still making terrible drinks in bars with sweet and sour and bad ingredients. And I was like, man, there's got to be something more to this. And, or to that whole, the history of why we have cocktails. I don't even know what pushed me down that road in the first place. Yeah. But I was interested in it. Started doing research, started finding old cocktail books that were written in the late 1800s, kind of up until Prohibition, which is that golden age of the American cocktail. Yeah. And it was just a historic world that blew my mind. And met a guy in Houston, just friend of a friend that was bartending in a restaurant. Let me back up a little bit. There were no restaurants in Houston at this point that gave any sort of care about good cocktails in their bars or even the good restaurants. It's like you'd order an old fashioned and it tasted good, and you'd order it a second time and it would be a completely different drink. Like no one is putting any sort of attention to detail in drinks in Houston. So met this guy and we became buddies, and he was working as a bartender in a restaurant. And he was doing drinks like this, but the restaurant was not supporting him at all. Yeah. And he ended up moving to a new place that was this like neo ice house barbecue joint. And he was doing these amazingly detail-oriented cocktails there. And in Texas, if you, in the mid 2000s, if you opened a barbecue joint that wasn't exactly like every other barbecue joint in Texas, you immediately put a target on your back because everybody's got an opinion, right? Yeah. And it's like burgers, or pizza. It's like, this is the best pizza. This is the best pizza. It's like, well, you just open yourself up for criticism. And the Neo Ice House barbecue joint definitely received a fair amount of criticism, but the bar was killing it. It was doing like 80% of the gross sales. Huh. So in a really weird environment. So we said, why don't we try an open bar that's just a bar that just focuses on stuff like this? We're 26, 27 years old, had really no business doing something like this on our own, but we cobbled together $10,000 and $15,000 at a time until we had $250,000. And we placed a down payment on a lease for a space in the Montrose area. And we had no money to hire a general contractor. So we went in and we, like the day after we signed the lease, we started swinging hammers and did as much of that project with our own hands, me and my buddy and two other guys, as we possibly could. And we opened, there was a ton of anticipation. And when we opened, it was like nothing that we had ever seen or anticipated or ever expected. The bar was called Anvil Bar and Refuge. It's still around. It's been nominated for James Beard Award after James Beard Award. It's like the Susan Lucci of James Beard Awards. It's always there and it's always on the list, but it's never won. Right. But it was an amazing learning experience. And the second, we paid our investors back in 9 months. And I think the following quarter, I got a distribution check for more than I had made the previous year working at Metro. And at that point, I was officially done. I'm like, love this stuff. I love the restaurants. I love the grind of it. What I didn't love was we realized very quickly that we didn't have a lot of experience. We didn't even know each other, my business partners and I, and we realized that we were much better friends than we were business partners.
Okay.
So I peeled off, sold my quarter to the other three guys, and basically took that money and reinvested it in our family's ranch in South Texas. I grew up in a ranching family. My grandfather, who was the primary caretaker of all that, passed away in the mid 1980s, and like a lot of multi-generational family ranchers over. And so we turned it into like basically just our deer hunting place in the fall and winter, and leased the land out to another rancher who just wanted the grass for his cattle. So we hadn't really done anything on our property since the mid 80s to speak of. And through opening Anvil, the bar, I had met every great chef and restaurateur in Houston, and they were all asking for the same things. Omnivore's Dilemma and Food Inc. had just come out and immediately gave most of the nation that was interested in this sort of thing a bunch of anxiety about like the provenance of their food and where it came from and what was in it, whether it was chock full of antibiotics or, on the grain side, if it was a highly genetically modified corn or wheat variety. And people were just asking questions. Like, man, all the restaurateurs wanted high quality, locally raised meat protein. So I reinvested the money that I made off of the Anvil deal into our family place. And we started raising pigs and sheep and chickens. And we were like, I can't just raise sheep, lamb, pork, and chicken without going all the way intense on the details of that. So we helped import a breed of pig from Austria to the deep south for the first time ever. This is a pig variety that started in the Austrian-Hungarian Empire in the 1830s. It's called a Mongolita pig. They're wild. They look like they have poodle hair, and they are incredibly fat. And so, charcuterie, cured meat, doing that in restaurants was a massive thing in the mid to late 2000s, early 2010s. And I was like, man, we're going to find the best pig with the best fat quality, and we're going to figure out what to feed them to get the best quality of the best consistency of fat possible. And that led me down a crazy road to, 2 years later, I had, about 8 different breeds of pigs that we were experimenting with, and rare breeds, like endangered breeds, and we're crossbreeding them. And when I go down a rabbit hole, it's a deep one. And over the course of time, I'm driving around all over the state, figuring out where to get these pigs processed, where to get them butchered, how to get them butchered well. It's like most of Texas is driven by rural processors that do a boatload of deer every deer season. And then outside of that, it's just a cow here or a cow there or a pig here or a pig there. And I'm selling to, the best restaurants in the state. And I was like, the butchering has to be high quality. Like you can't mess it up, because they'll just reject it. And then I just am sitting on product I can't sell. So about that time, one of my best customers was a chef in Houston that was really kind of ready to leave the restaurant. He was making beautiful food with our animals. And one day I was delivering a pig to him in downtown Houston, and I was like, hey, I've been complaining and such about not being able to find people to make products that I can sell to restaurants from our animals in a really high quality way. What if, would you ever consider, like, just maybe we open a butcher shop and we do it all ourselves? There's not a good butcher shop in Houston, and I think it's the right time to do something like that. It's like, yeah, I'll do that. It sounds fun. I'm kind of ready to get out of the restaurant, the actual, grind of dinner service every night. So we opened Revival Market in 2011 in the Heights, and it was incredible. It was it was Anvil all over again. It was as busy as it could possibly be. We were making a boatload of mistakes just because and Agricole has never been a company to learn from the mistakes of dialing in a previous concept. Like, we've never repeated a concept. So it's always like we just start from scratch every time. And so there's always a learning curve when we do something new. But this one was a pretty big learning curve. And we did, the gross sales were insane, but we were not making any money. And we just couldn't figure out why. Well, we were super green, and we didn't have good accounting. We didn't have good bookkeeping.
Yeah.
We didn't really know what a P&L was, or much less how to read one if they gave it to us.
Yeah.
And it was just like a survival mode as we grew, and it paid our bills, and we paid our investors back, but there was really no money left over at the end of the day. And I'm like, how are we doing $2.5 million worth of business in this one space? And we're literally plus or minus 1% every month,
right?
On the profit. And because we also get bored. I was driving to the bank one day, and right down the street from Revival Market, there was a space had come available to lease, and I called them, got the number, and it was crazy cheap for the heights. It was like $12 a square foot, which just even then wasn't a thing. And I talked to my partner, Ryan, and he's Italian, and he had always wanted to open kind of a casual neighborhood pizza pasta joint. And so we pulled the trigger on that and opened Cultivari. And literally every restaurant that we've opened after that has grown that way. It was just like, see an opportunity, see a hole in the market, and try to fill it. But while also staying really sensitive to what kinds of things are going on all over the world with restaurant trends, and being on the front end of that. But it's been a wild ride, and it's not for everybody. But it's been very satisfying for the last 10 years. And we've learned just so much.
Yeah. Super interesting.
That's the short story.
Yeah, that's great. So I'm just trying to think about, so just to paint a picture around what the business is today, you guys have 6 locations, 6 different concepts that are all running. And they all appear to be the common theme. They're all different concepts in terms of the food. So one's Italian, and then there's Americana and different stuff. But the common theme is just this like different caliber of food and preparation that's happening, right? Is that the thread of what Agricole is about?
It is. And Agricole is a French name derived from agriculture. I feel like when we started Revival Market, we firmly rooted ourselves and our ethos deeply in believing in sustainable agriculture and realizing that there are problems with the commodity food industry in America. And we wanted to, whenever it was reasonably possible, support farmers that were not just local to Houston, but farmers who were doing a really good job in their animal husbandry and in what they're feeding their animals. And that rooted the whole company. So whether it's our whiskey beer taco joint or Revival Market or the Italian place or our kind of modern Texas place in East Downtown, it's all rooted in supporting people that we know are doing a great job and giving us product that we can stand behind with our customers.
Yeah. And then does that translate into a better ability for you to charge higher prices and compete? I mean, I'm going to say the F word for Tita.
I think so. It's when you started the podcast with the intro, you were talking about niche things and niche businesses. And, I've never really thought of us as a niche business because it's pretty easy to open a restaurant. That's the easy part. It's like opening and figuring it out and turning a profit and staying open is more difficult. And I think it's easy for somebody like Tillman to just bang out restaurant after restaurant after restaurant, because the food, and I know Tillman, I've never told him this to his face, but
oh, you actually know him? I'm sorry.
Yeah.
I don't know.
He comes into our restaurants all the time.
Oh, yeah. Okay. Super cool. All right. Continue.
Yeah. But it's the food, and I don't think he would disagree with this. The food is pretty lazy.
Yeah.
They have figured out the formula that works for Landry's, and it works. A lot of the scratch made nature of food is taken out in their restaurants because it's easier to purchase from a bigger company that does a lot of the early work for you. And when you open restaurants in the types of neighborhoods that a lot of the bread and butter of his restaurants exist in, you just can't charge a lot for food.
Yeah.
The clientele is not our clientele. I mean, all six of our places, we're in East Downtown Houston and in the Houston Heights. They're both affluent neighborhoods, and our clientele is such, and they're able to pay for higher quality food. And I think this is one of the biggest problems with the overall food perspective in America. It's like the people that need the highest quality food typically can't afford it. So, and we're definitely not going to solve that problem on this podcast today, but we are fortunate to be able to work with the best product. And another part of our cooking ethos is just to buy the best ingredients and cook them well and not get in front of them. Kind of like, we're going to minimally process all of this food. We're going to make it delicious, but we're going to get out of the way,
right,
of the ingredient. We're not going to make some crazy cooking method cover up the fantastic product that's coming in. So
yeah, no, I hear you. Well, so does, like, compared, let's say, as a percentage of sales, like a typical, like, okay, well, I'll stop picking on Fertitta because he comes to your place, but let's say, okay, Olive Garden's cost of food, including spoilage and theft and all that stuff, versus y'all's as a percentage. And I don't even know what the industry averages are for restaurants, but let's say it's 30%. Are yours higher or yours lower than theirs, or does it end up just evening out?
We toe the line at 30, and that's going to be a blended cost of good average. Sometimes our food costs are higher, but we offset it with our alcohol costs, our food and our liquor, beer, and wine, across the board, because we can get a better cost of goods percentage on those. And if we're selling 40% alcohol at a restaurant, you can afford to run with a little bit higher food cost, as long as that blended average comes back down to about 30%. Okay. We really like it at like 27, because that gives us a little bit of margin for error. But
yeah,
we peg 27, 28% across the board.
It's this is fascinating, because I don't know if I shared this with you, but we started a drive-through coffee shop chain last year
awesome.
with a partner. Yeah. So kind of a Dutch Brothers style, the opposite of what, if Tillman was going to start a coffee shop chain, this is what it would be. So it's at the anti-niche, but it's very interesting that the targets that business and the CEO of it have set are very similar to the numbers you're putting out. It's like, okay, like COGS should be 25 to 30%. If we're doing a great job, it's 25%. And then we're going to talk about labor in a minute. I bet it's the same. So it's super fascinating. Cool. So, I mean, as you think about designing this restaurant group concept, right? So we talked about the idea of like a Fertitta or a Darden's just stamping it out over and over again and reaching the mass market. I mean, y'all have built a group out of six different concepts. Every single one of them is unique. So there's upsides to that, which is you can appeal to a lot of taste, but the downsides and operational efficiencies seem significant. Like, how did you guys end up with that idea? Or was it just like, hey, let's do this other thing that seems cool because you're shiny object people?
I wish we could say, no, we planned it this way, but it was truly not planned, and it was 100% organic. Now that we have 6 restaurants, we've been able to realize some efficiencies with just the fact that we buy so much chicken, we buy so much pork, when we opened Cultivari, we should have, if this could have been a thing, like if Parmesan cheese was IPO'd and you could buy stock in it, we should have done that then. Because we go through like a shocking amount of parm at Cultivari, just wheel upon wheel every week of parm. But we've been able to realize some buying efficiencies with being able to just spread stuff out that one restaurant can't do. We just buy in such quantity. Revival Market now acts as a commissary for the other restaurants. So like for our pepperoni pizza at both pizza places, Cultivar included, we make all that at Revival Market. And it helps us, kind of prop up that business, but also allows us super tight control on the type of product that we would buy. Our idea is that if we can make something better than we can buy it, or if a product doesn't exist that we want to use, we'll make that in-house. But if we're not going to make Parmesan cheese.
Got it. That makes sense. Okay. So, and then I see how you got there. And then also listening to you talk and what your personality is, like it totally makes sense. Like you guys love developing these new concepts and bringing them to market.
Yeah, we like just the exploration. And I think it's like we've thought for years that if we were going to do multiple locations of any of our concepts, Cultivari and 8 Row Flint make the most sense. But like that, I immediately, like just thinking about it, I get bored.
Yeah.
So we've
really
always kind of wanted to just explore new things. Now we learn things from one to the next that concepts that we duplicate, but just to do 15 Cultivaris just sounds like it's just not what I'm good at.
I hear you. Well, and it's also something, I've seen watching restaurateurs around here is like, there's some of them that are terrible chefs. Like the food is mediocre at best, but man, from an operations, marketing, concept standpoint, like they kill it. And then I see other folks that are terrible operators, like terrible. But food wise, killing it, concept wise, killing it. And like, it's cool that it seems like you guys, well, I know of two businesses like yours and Union Square Hospitality. Like those are the two I know. But like,
I'll totally take that compliment.
Yeah.
I feel like Danny Meyer is certainly on a different level.
Well, I read his book earlier this year when we got into the coffee business, because I was like, well, like I need to know how to make people happy. This guy seems to know what he's doing. So I read the book, but his story of how he organically grew to have this multi-concept thing, even down to Shake Shack, was very akin to what you guys did.
For sure. Yeah. And, we didn't invest in ourselves early enough. I truly, for the first 6 years, we had, like I touched on earlier, terrible accounting and terrible bookkeeping, and just kind of survived in spite of it. The best thing we've ever done as a company was hire a really amazing CFO. We would get, we started with really bad accounting, and then we just got bad accounting, and then we got okay accounting.
Wait, I will tell you, there's a worse accounting than all of those. It is dishonest accounting. That's worse than all of those. So just so you know, you didn't have the worst possible one. It's the accountant that steals from you. Okay, keep going.
Yeah, no, we did avoid that. And when we had okay accounting, we were seeing a P&L maybe once a quarter. And that's just not fast enough. Like you can't make decisions based on that. And so when we hired a true CFO, it took us about a full year to just organize what we're doing. And,
interesting.
And just to get an accurate picture, because we'd never had one. So after he got us organized, we now get an extremely accurate P&L 10 days after the month closes. And we have about a 2.5, 3 hour meeting as partners in him, and just go over the whole thing. It's like, it's so amazing how fast liquor costs can fly out from under you, or wine cost of goods, or food costs can fly out from under you, labor. And that gives us the tools and the power to then go straight back to the general manager, straight back to the chef of each place, to say something's weird here. And it might be just an invoice that got labeled incorrectly, that put all the limes that were ordered in the food cost instead of in the alcohol cost, because we use a lot of limes in the same margaritas. So it's not fair for those limes to get pushed into the food cost category. So they can then go back and look at their invoices and say, you know what, they did, that's what happened. And here's where it is. Like, okay, so now everything is normal. It just got allocated improperly. But it is single hand. I would do it over and over again. And there's almost an infinite amount of money that our CFO should make to keep us. It's the best investment we've ever done.
Yeah, that's great. Well, it sounds like, at least describing you and your partner, Ryan, you guys are very much like, I don't mean this in a bad way, but you're, technicians, you're artists in your space, and you love your space.
And we're pragmatic, and we're not super emotionally attached to any one idea.
Yeah.
We can have an idea, and I think having 6 wholly different restaurant concepts allows us to explore ideas and just throw one out, see if it works. And if it doesn't work, back away like it never happened, and go back.
I love it. Cool. So I'd love to switch gears a little bit. How is the business organized? So you've talked about the CFO. He's clearly on the headquarters staff. Like how do you guys go about organizing and putting together all the business?
So on the upper management side of things, we have a CFO, we have a director of operations, we have a culinary director who is also a partner, and then I do all the beverage programs, and my partner handle just directions on food and making sure each chef at each restaurant is making the kind of decisions we want them to make with the food program, and making sure that the food is ultra consistent coming out of the kitchen. We need it to be the same every time. So on a weekly basis, CFO, culinary director, Ryan, me, director of operations, have Zoom meetings to just catch up on what happened the week before, make sure everybody's on the same page and aware.
Yeah. And then, so, there's, you mentioned the 3 of you own the business together at this point, right? Is that what you said? There's you two, Ryan, Brian, and you. Is that accurate?
No, Ryan, me, and Vincent, who is our culinary director.
Vincent. Oh, he's on the website. There you go.
Yeah.
Good looking guy. Okay. So the 3 of you guys are co-owners. So how is that organized? Are you guys just equal partners? Is one of you the CEO and majority owner? How have you guys structured that?
Ryan and I we're 50-50 partners in 8 Row, Revival, and Cultivare. And when we decided to do the projects in East Downtown, Vincent had been our culinary director for years, and he started as a cook at Revival Market 10 years ago.
Okay.
And just flew through the ranks because he's a hyperly intelligent human, and a lot of fun to be around, and has great ideas. When we opened East Downtown, we made him a full equal partner in those concepts.
Okay. So so I understand there is the headquarters concept, which is its own thing. And then each individual restaurant is its own thing. And some of those are 50-50, you two guys at this point. And I know early on, it sounds like you took some investors for some early stuff, but we'll come back to that. And then some of the other restaurants have, Vincent is a third in one of those, for example. Okay. And then each restaurant has individual P&Ls, and then headquarters charges. How does that work? Does headquarters charge back?
So we, a couple of years ago, we reorganized and formed Agricole Hospitality Management Company.
Okay.
So all of our management teams, even at the restaurants, and when I say management, chef, sous chefs, general manager, assistant managers, and then our kind of corporate team all are employed by the management company.
Okay.
And then each individual shop employs its own servers, line cooks, bus staff, barbacks, etc. So the management company houses all of our managers. And
so like the GM is on HQ's payroll then.
Mm-hmm. And then we just we bill each individual restaurant for it's just as a pass-through cost.
Got it. So, and is each individual restaurant its own LLC or okay? And so that limits liability flowing up to the parent company in theory. How do you keep one restaurant? Restaurants go under water all the time. Maybe none of yours, but how do you keep one restaurant from bringing down the whole ship, or is that just not a worry based on how good you guys are?
We've historically not been super good at that.
Okay.
It'll also help to understand the investment structure. We started with two primary investors, and one of those investors bought the other out a few years ago. And he actually came on as a non-operating partner when we started opening more. So that's where the cash to open the restaurants comes from. And when we do distributions, he just gets a quarterly distribution based on his percentage of ownership in the company, just like I get a quarterly distribution based on percentage ownership in the company.
And by company, you mean individual restaurants, or you mean the management company?
Everything except the management company.
So if this is kind of a fund with operating companies, you have the management company as your management company, and the outside, the money person, it's a he or she? He. Okay, good. So he doesn't own anything in the management company. You guys do that. And then when you guys want to open up a new restaurant, you go to him and say, okay, here's our business plan. Here's the idea. We need $2 million. And which maybe that's high for what it takes to open up a restaurant these days and get to $1. But you go to him and you ask for that. And then then what happens?
So he's either in or he's out. He's always been in so far.
Okay.
So we haven't had to navigate the out, but then we'll start the architectural design and permitting and really dialing in the concept. Mm-hmm. Dialing in the concept is what happens first, because that's going to drive design. That's going to drive everything.
Yeah. Well, and love to dig into that. Before we go to that, how does the structure work with the investor? How does he get paid? Is there a rev split or how's that work? So
when we have quarterly profit distributions, he owns a percentage of the whole company, just like we do. And the distributions just get split based on his percentage of ownership. So if we have $100,000, $200,000, whatever it is to distribute over the course of a quarter, he just gets his slice of that.
Got it. And is there like a prefer, like I've heard of structures with restaurant investments where it's like, 70-30 in favor of the investors till they get their money back, and then 50-50 after that. Do you guys have a similar scheme, or
we started that way? We started that way, and we're paying them back in an extremely reasonable amount of time. And so after 8 Row Flint, we did a deal where it's just you get paid when distributions happen, and he's been happy with that.
Yeah. And so have you guys done
so there's no preferred return on
no preferred anything. Return at this point. And you think is that because you're just proven operators at this point?
Yeah.
Got it. Okay.
Most restaurant concepts will do some sort of preferred return and then a waterfall over the course of they get their money back in a hopefully a really reasonable amount of time, plus whatever interest that initial payback is agreed upon. Mm-hmm. And then a lot of restaurants will then pay it back again, but instead of being like a 80% profits back to satisfy that initial capital contribution, it'll go to like 50-50 or until it's paid back again, and then it'll flip the other way.
Got it.
A lot of my colleagues have operated that way.
So just to put some numbers to those concepts. So like the preferred return might be 10%, 12%, and that can accrue, or
pretty normal.
10% is pretty normal. And then in terms of say like the folks, you're not them, but say the folks that are doing the splits, like, is it 70-30, 60-40 is typical, and then 50-50 after that? Or what do you see most in the market?
Like when we did Anvil, it was 90-10 going back to the investors.
Okay.
And then it went to 60-40. And then I think it went to 80-20 where we were getting 80% back and they would just have 20% for perpetuity.
Got it. And so that it sounds like it kind of brackets their returns, right? Like if things go really, really well, you can do well, but gives them a chance to have a really good chance of getting their money back.
Exactly.
What, for the folks that did that early on, or this guy, what is typically the timeline that the payback happens?
We really like it to happen in about 2 years.
2 years.
Mm-hmm.
Okay. And what is the order of magnitude cost to open a restaurant these days of similar kind of concept? Is 2 million a wrong guess, or is that high?
Well, that's higher than anything we've done outside of the concepts in East Downtown. Mm-hmm. We spent $700,000 on Revival Market. We spent $600,000 on Cultivare, and we spent about $550 on 8 Row Flint.
Okay.
But we're scrappy. Like we're hunting certain used equipment is better than other used equipment. Like I never want to buy a used walk-in cooler, but I will totally buy a used under-counter refrigerator, depending on what kind of shape it looks like it's in.
Yeah.
But
why is that, by the way? What's so bad about used walk-in coolers?
Man, there's just always so much moisture in a walk-in cooler.
Yeah.
Especially in Houston, it's humid all the time. And no matter how well sealed you think that walk-in cooler is, moisture still happens. And
got it.
Electrical condensers and refrigeration equipment just do not like to be in a moist environment. So it eats the shelf life on those types of pieces of equipment.
Got it.
Yeah. So, ice bins, certain brands of ovens will feel very comfortable about purchasing used. And I think that because my wife and I do all the design, interior design for the restaurants as well. And, you can go find a guy who's going to build a custom banquette and it's going to look super sick and it's going to be awesome. But what's the function of that banquette? Like a custom banquette that's got any size to it might be $20,000. Or I could go find really amazing chairs at, some antique show that are well built and they might be metal and they're $80 a piece.
Right.
And so that at the end of the day, you want a butt in a seat, right? Because that butt in a seat is going to be eating and paying money, and it doesn't really matter how much the seat costs if it fits the vibe that you're trying to create.
Right.
So we try to spend money where it's important and really be careful for the what would you call them, like the sexy projects.
Yeah. No, I hear you. Well, and you're welcome to duck this question or tell me it's a terrible question, but what sort of returns have the folks that have invested with you gotten? Have you guys done that math?
We haven't really done that math, and I'm not trying to duck that question.
It's so funny because I'm like, okay, tell me how you made money. And you're like, let me tell you how I get some awesome chairs really cheap. It's like,
yeah. I mean, what I can say is for the last 3 years or so, pandemic not included, because that was just such a weird year.
Yeah.
We net 18 to 20% over the course of the year on any of our projects. So if it's a $1.2 million kind of gross sales place, it could be lower, because a lot of times just that top line gross sales helps bring up the overall. It's not the right metaphor, but like rising tides, lift all ships. It's like
you're saying about, because you have high fixed cost, the more your sales grow, the more your incremental, more drops to the bottom line increasingly. Okay.
Correct.
Got it.
So, if 8 Row does $3 million a year, it almost monthly pegs 18 to 20% net.
Yeah.
Cultivar same way.
So what is and maybe I'm interrupting your point, but what is the other? So if $1 million comes in a year, let's say from a restaurant concept, we already talked about it's 25 expense wise, 25 to 30% goes to food and spoilage. You're going to try 18 to 20% net free cash flow margin. So that's close to 50%. Where does the rest of everything go of that dollar that comes in?
So because we have a blend of salaries and hourly labor sections of our businesses, we try to peg 20% or lower on hourlies.
Okay.
And that gives us about 10% of our top line sales to dedicate to salaries. And then about 20, so blended 30% on the labor.
Okay.
28 to 30% on the labor is what we try to hit. And then 20% on kind of our fixed costs.
So rent and repairs and all that kind of stuff. That gets you to 100%.
All that.
Okay.
Yep.
That totally makes sense. So is that high, 18 to 20%, or is that low for specialty concepts like for restaurants?
I've got a buddy who's got a chain of Mexican food restaurants in Houston, and they consistently peg 25 to 27% net on a monthly basis. And I think,
and that's free cash flow.
Yeah.
You start with $1, you end up with $1.27. That kind of, okay, perfect.
And so, I've spent because when he told me that, we were at a Sporting Clays charity event, and my jaw dropped because it was like, dude, we work so hard to get 18 to 20% out of these things. And he's like, oh yeah, we wouldn't even mess with that. He's like, I wouldn't get out of bed for that. So I think that goes back to our earlier talking point discussion of the quality of food we choose to bring in as product. We spend more on meat protein than anything because we buy really high quality meat protein, and we're not a Mexican food restaurant.
Yeah. So
a lot of those are higher cost of goods, like steaks or fish protein. It's also highly perishable. So the fish protein, not the steaks. And it's just the cost of goods is higher. It's just a different style of restaurant. I think you can really do that when you can get that 25, 27% if you're running tight. But if you're also, you're selling tortillas and beans and rice and salsa.
Yeah.
It's just easier to scratch more out of it.
I mean, I listened to our coffee CEO and the general manager today, just like the machinations they had gone through to try to figure out how to save $250 a month on ice was just like I was like, this is great. I am so glad I'm not being asked to do this project because this would be terrible.
Yeah. I mean, we sweat paper goods. Paper goods kill us.
Yeah.
We started charging for to-go ware about 2 years ago, thinking we were going to get all this pushback, but we would sit there and look at the P&L every month. We're like, man, we spend so much money on to-go ware. And it's another ethos thing too. It's like, sure, we could buy cheaper styrofoam to-go ware.
Yeah.
But we as a company, it just doesn't line up with our ethos and our branding. My talk just came out here. There are ways we could scratch more profit out of it. It's just like that line that we're unwilling to cross.
Yeah. No, totally dig it. I mean, and going back to the capitalization stuff, like it sounds like the end state is after people get back a certain amount of return, you and your partner own 80% of the business, 70% of the thing, and they get a coupon forever. And I mean, it just seems like a have your cake and eat it too situation for you where the capital risk.
We're in a very unique circumstance. And I realize that, like, where our financial partner is willing to not take a preferred return. It's like, that's a dream team situation for us.
Is this funny? And not, you can duck this one too, but sometimes you see people that invest in passion projects like this and they're not in it for the return. I mean, is the person that you're partnering with, are they all about the return, or are they about like, hey, like I'm getting other kind of, return on investment here besides that?
He's very diverse in his personal portfolios.
Yeah.
So he's not super in, on our back the whole time, but he gets the P&Ls every month too. And you better believe if something's off, he'll pick up.
You get a phone call?
Yeah.
Yeah, it's interesting. I mean, I watched a group here locally in San Antonio back, a kind of niche restaurant chain as well that came along, and I never really heard what happened to it. But I think people got tired of worrying about some of that stuff. So, anywho, super interesting. But yeah, so it seems like a cake you can eat it too thing where somebody else is taking all the downside risk, you're putting in sweat equity. And then the better you do for them, the more you own long-term. And so you look up and without putting a lot of personal risk on the line, you're owning half or more of all these restaurants. Like that's pretty awesome.
That makes it extremely motivating for us to run a tight ship.
Yeah.
It took us, like I said, years to get to the point where we were content. And it's still a daily grind, like just to make sure that we're on top of it, because the second you take your eyeballs off of it, it can go sideways quickly. So it's motivating to say, okay, we've got concepts that are busy. If for as many things as we've done the wrong way to begin with, one of the things that I think we've always been super in tune with is giving people what they want when they don't necessarily even know they want it. And then creating a hospitality feel. All of our, we have an amazing amount of regular customers that come in weekly, sometimes several times a week. And when you're in a city as big as Houston, you've got a ton of options. And so it's not just about producing good food. It's about making people feel like this is their third place. You got work, and then you got home, and then you got your third place that you feel really good going to.
Yeah.
So
I dig it.
Yeah. So we spend a lot of time on culture.
Yeah. Well, so does that, usually people spend a lot of time on culture because that's got a lot of benefits, right? From a customer standpoint, you like it, but also makes the employees much more likely to stick around. Are you guys, where are you in terms of kind of the benchmarks for turnover?
Our upper management really doesn't change much. Like we've had people with us for some of them since Revival Market opened 10 years ago, and some that have just come on board when it's just time. Sometimes with employees, even amazing employees, they just kind of run their course. I'm thinking about one specific manager at Cultivare about midway through Cultivare's lifespan so far. She was incredible. She's one of the best employees that has ever walked through that door. And we would have loved for her to be with us for the life of the whole restaurant group. But we knew that she was going to go open her own place eventually. And, at that point, we weren't in a position to help her open a place that we could also be involved in. We do some of that now, but it was just time for her to go, spread her own wings. And so we've had a little bit of that. And then inevitably, sometimes just people have to relocate to different cities for family reasons or whatever. But we don't see a lot of turnover in our upper management. We bonus them out also based on profits quarterly. And I think in and above their expected annual salary, that's a nice thing. We give a lot of PTO. And post-pandemic, we're in a totally new world of employment situations. There are certain shifts in our East Downtown project. We've been wanting to open brunch back after the pandemic for 6 months, and we can't find staff to do that. So we're not open for brunch yet.
Wow. So
I read a Wall Street.
Oh, go ahead.
I read a Wall Street Journal article a few weeks ago that estimated that 30% of the restaurant industry left the restaurant industry permanently during the pandemic.
Yeah.
And I mean, I don't know of a restaurateur anywhere that is not having an absolute beating hiring staff.
Yeah. Yeah, it's fascinating to watch how many places are operating, if at all, below capacity, just because they can't hire folks. So, so all the executive management of the restaurants, they have bonus plans tied to the P&L of the restaurant. Is that how you guys do it? So you carve out a percentage of the profits and say, okay, we're going to build a profit pool.
Yeah, and it's based on milestones. Yeah, well, we create a budget at the beginning of the year. Yeah. We share that budget. If your food cost is under this, if your booze cost is under this, if the overall COGS and labor are under these percentages, that is going to ensure us that we realize a certain percentage of net profits every year, and they're bonused a percentage of those. And we do that pretty much quarterly.
Yeah, totally dig it. Well, yeah, so I see how that aligns. So then what happens if, say, one of the restaurants starts operating in the red, which may have happened last year? My condolences for being that you were in the restaurant business last year. So given they're separate with separate capitalization structures, like what happens there? Do you guys have to come out of your own pocket personally? Do you go back to the investor?
No, we went, last year is a perfect example because we did more robbing of Peter to pay Paul last year than has ever happened. Yeah. We had a significant investment in a restaurant that had only been open, so just to back up, our East Downtown Houston restaurants are 3 restaurants under one roof that share a centralized kitchen.
Okay.
For efficiency reasons. And that trio had only been open for about a year before the pandemic hit. And it was going very well entering into 2020. And then when we shut down in March, it just became, crazy. Mm-hmm. And that is those restaurants are not in an established neighborhood like our Heights restaurants are. So the neighborhood doesn't operate like a neighborhood. It's a place that people go as a destination to eat and drink. And without the ability to have as much fun as you wanted to last year, those suffered dramatically. So because we only have one financial partner, we made the decision collectively that whatever profits are coming out of the Heights restaurants, we can use those to float East Downtown until it gets back.
Got it. Well, so that was an obvious upside of having a single financial partner. There's the obvious downside, which is you're not building relationships with other potential financial partners in the future. So I assume that's something you guys have premeditated. And maybe that ties in. Go ahead.
Well, I was just going to say that kind of goes into, because a lot of people are like, well, what are y'all going to do next? It's like, man, the restaurant industry has changed so much over the last 10 years. I feel like what we've got is really good. And I have other ambitions in life outside of the restaurants, just pathways that have been opened because of the restaurants, but doing more restaurants in a metropolitan city with a massive amount of choices of other restaurants that people can go to. Yeah. It's even before the pandemic, it's getting harder and harder and harder to open unique things that people are interested in, that push the envelope, that can also be profitable. So we have my partners and I have pretty much collectively decided that unless something that we are not expecting comes across the table, we're pretty much done in Houston.
Okay. Well, all the cool kids are going to San Antonio. I don't know if you're aware of that. Pinkerton's just opened up here.
Oh, so. I know. Well, and my wife and I live in the Hill Country in Lakey.
Okay.
Full time now. So we're back in Houston pretty much 1 week a month. And then we're opening a distillery in Marfa this month as well. So Lakey's kind of halfway. So we're kind of a week in Marfa, a week in Houston, and then the balance of the month we're out there. And we do everything via Zoom for our management calls now, which is everybody loves.
Yeah.
It's like, and we would have never explored that pre-pandemic. It worked.
Yeah.
So
super cool. Well, yeah. And then I'll definitely be interested to follow along and maybe interview you in the future about being the distillery business. Like I've got friends that have done it and done well, and I've got friends that have not so good.
For sure.
So that's for real, for real.
Same thing as the restaurant business.
Oh yeah. I mean, I've rarely been pitched restaurant concepts and stuff to put money into, but the one time I was pitched, they were trying to raise like $12,000 to start a restaurant, and I'm pretty sure the concept that they have now produces that much a month. Like, and I was just like, ah, man, such a doofus. So it is what it is. So I was curious about just kind of the portfolio aspect. This is a note I took down, the portfolio aspect of having it. You see these, the 80-20 Pareto principle and stuff like that shows up in are you familiar with that?
I'm not.
Okay.
I'm a simpleton, man. I'm a music major from Baylor.
Okay. Well, I'm a computer science guy who reads a lot of business books. So that's what I do. Okay. So Pareto is Pareto. And so he was a monk back in the 17th, 18th century who went and discovered that in nature, over and over again, distributions would happen on an 80-20 basis. So for example, if you have 100 locations or 100 customers, 20% of them are going to be 80% of your profits. If you have a portfolio of investments that are all high risk, 20% of them are going to give you 80% of the returns. Like he would see that over and over. And it would translate to like nature as well. Like 20% of the crops in the US types produce 80% of the calories. And so it ends up that way. So when people do portfolios and stuff like that, or have a business like yours, oftentimes you see an uneven distribution that sometimes mimics that or something different. So that was my question. Like, how does the distribution of like impact differ across portfolio, or is it pretty flat?
I think it's an excellent question. 8-row Flint and Cultivare are our highest earners. Mm-hmm. The East Downtown projects pre-pandemic were on track to match that.
Wow.
And then the Butcher Shop is the lowest earner. So I don't know what that ratio looks like, but East Downtown has been a slow build back from the pandemic. So we lost a boatload of money over there during 2020 just because our fixed expenses are crazy.
Yeah.
And we carried what we didn't want to do. We furloughed most of the hourlies immediately in March of 2020. And we're like, man, well, at that point we were thinking, oh, well, we'll be closed for a month, maybe. And we can't let our management teams go and then expect to open the restaurants anytime soon after that. So we carried most of the management staff through the pandemic. Now it took a lot longer to get reopened than we ever expected it would, but no one had ever navigated a pandemic before, right?
Right.
Or not in anybody that would be relevant to us. So East Downtown, we just knew was going to take a minute to bounce back, and it is now. So I think by the end of the fourth quarter, that October, November, December, it will be back to being as much of an earner as the others, 8-row and Cultivare are. That's a long answer to your question, so I don't know if that got you what you needed there.
Yeah. Well, I mean, it sounds like there's an unevenness to it, and some that are on the upswing and some that are pretty stabilized. So totally dig it. Cool. I had a couple more questions, and then, so, I mean, I'm curious about like a level of like cyclicality in the business. How long did it take you to start to get a feel for how things like school holidays or Christmas breaks or any of that kind of stuff would affect business staffing, all that kind of stuff? Like, was that a quick learning process, or are you still getting surprised by it?
We're still getting surprised by it. I mean, we have enough data now to know that like September is historically one of the worst months of the year. So is January. And what drives that? Well, people have been blowing cash on family vacations, getting kids back to school from summer, and they tighten the purse strings in September.
Mhm.
Houston, just the weather pattern is an absolute beating in September.
Yeah.
So it's hot, it's gross outside. September is always a turd for us.
Mhm.
And then same thing happens after the holidays. People have been spending money and eating like crazy, and between Thanksgiving and Christmas, and then they blow it out for New Year's, and then they all go get gym memberships in January.
Yeah.
So January is historically not very good, and then it starts to pick up again in February, and as soon as the weather gets pleasant outside, it picks up and it goes through the same cycle.
Yeah.
What's been interesting for us is to figure out how to prepare for holidays, like 4th of July, which is always on a different day of the
Right.
year. And I think now that we've been open 10 years, we're still not great at it. In the pandemic, 2020 and then 2021 still being more of it's not like a let's go on a European vacation kind of deal. It's like, let's drive around for 2 weeks or 3 weeks of the year as a family. Leading up to 2020, we felt like we had a pretty good feeling on, well, if 4th of July falls on a Wednesday versus a Saturday, what that looks like. And post pandemic, we have no clue anymore.
Totally cool. Another thing I'm curious about, what if anything are you guys kind of doing around some of the experiments that people are running, like the talk guy, Nick Kolkanis, totally butchering his name, but like dynamic pricing, bids for reservations, any of that kind of stuff? Is that part of y'all's model, or are you just keeping it simple?
It's really not. We have worked so hard to cost our food appropriately and cost our drinks appropriately.
Yeah.
That our number one goal as a company is to give you the highest quality and most consistent and interesting food that we possibly can for the cheapest price that we can.
Yeah.
We try to be a good value to people that come, and we don't want anybody to feel like we're taking advantage of the prices that we're charging. So it also doesn't give us a lot of meat on the bone to do a lot of special things. It's just like, this is the price, and we're not overdoing it on that to begin with. So hopefully you understand that and you keep coming and all that.
Right. And the idea to build your vision, to build a durable relationship with these folks who are there 2 or 3 days a week. And that's what great restaurants are built on, not. And
I would, going back to your 80-20 rule, I think 100%, 20% of our customers pay 80% of the bills.
Yeah, totally makes sense. I totally dig it. Well, super cool. Is there anything I missed? Otherwise, this has been awesome. It's so good.
It's an industry. I'll say this because I'm working with I've worked with as a consultant for people and in the past to varying degrees of success.
Uh-huh.
And the restaurant business is such an easy business to romanticize, and it's relatively easy to get something open.
Yeah.
But if you are not 100% passionate about whatever it is within that industry that you are going down the rabbit hole on, whether it's coffee or cocktails or, pizza or booze or whatever it is.
Yeah.
If you're not willing to go all the way, your chances of succeeding are dramatically reduced.
Right.
Anytime we've done something new, it's like when we decided we were going to go open Cultivare, and we knew we wanted to be really, really serious about pizza. We're like, I don't know that I've ever thought of pizza in a serious way. Pizza is just kind of like, it's kind of all good.
Yeah. Bread, cheese, butter, and tomato paste. Like, yeah.
Yeah. I mean, it's like, when we got serious about that, we're like, we need to go eat a boatload of pizza.
Yeah.
And we went to New York. Ryan and I went to New York probably around 2013. And we had a list of probably 40 pizza joints of varying in different styles.
Yeah.
That we went for 3 days. And I think over the course of those 3 days, we ordered close to nearly 60 pizzas from about 20 different places.
Right.
And it was an all day thing. It's like they open at 11, we'll start there and we'll just walk to the next one, walk to the next one, jump on the train, go to the next one. And until you are willing to do something like that, and pizza's just the metaphor here, but until you're willing to do something like that, you can't form opinions on what you think is good.
Yeah.
You know, we ended up not going, ended up going in a completely different direction from, you know, your standard issue New York style sliced pizza. We didn't go Napolitano. Over the course of eating that much pizza back to back and notating certain things about different dough styles and different cooking styles, we came up with our opinion of what we really loved. And I would implore people that are dabbling or thinking about doing their own place, whether you're going to like open a kolache place, I don't know what it is. It's just, you got to be a nerd about it, or the odds are just stacked against you.
Yeah.
And then you have to be sensitive to what the neighborhood you're considering doing this place in. Maybe there's 6 pizza joints already in that neighborhood. So maybe that's not something you should mess with. Like, go in a totally different direction. But there's an unlimited number of things that you can consider before just jumping in.
Right.
Because it is relatively easy to just jump in and get it open.
Yeah.
But it becomes unfun very fast when it's not working.
Right. Those are wise words right there. So totally
it's like, man, like dreaming about it's the funnest part.
Yeah.
It's when things start not working out that you're like, I'll leave with this, this little thought. We had the opportunity 3 or 4 years ago to do a restaurant, take over a second generation restaurant space in the Montrose area, which is a very competitive neighborhood in Houston for restaurants. Yeah. And it was a fast turnaround, like 45 days start to finish from the time that we signed the lease to the time we reopened. And we had this idea that we wanted it to be kind of tiki, not tiki, as far as the drinks go. And the food was going to just celebrate kind of island cultures around the equator.
Okay.
So that could mean Thai food, that could mean Caribbean food, that could anywhere around the globe, around the equator. And we thought it was really cool. And we didn't think about it hard enough or long enough or nerdy enough. And even the elevator pitch on it was hard to explain to people. What is it? Well, it's kind of like tiki, not tiki, and it's island cultures from. I mean, you just see people's eyes glaze over and like, what is this?
Yeah.
And it was not doing well before the pandemic. And when the pandemic hit, we pulled the plug on it. It was like, that was the perfect excuse to get out of this not well thought out idea that we had in the first place.
Wow.
So just because you can dream it up doesn't necessarily mean it's appropriate.
Yeah, that's very true. That's very true. Super good. Super good. Well, dude, thank you so much for making time on this. Like, thanks for answering all my probing questions about how much money you make and stuff. So really appreciate your candor.
I mean, there's nothing that gives me more anxiety than watching somebody walk into the fire and not know what they're getting into.
Absolutely.
So the more candid I can be about the positives and the negatives of that, like, what else am I here for?
Yeah.
That's mentor and teach and learn from my bad decisions, from our bad decisions. You don't have to make those yourself.
Right. Super cool. Well, so I'm sure the listeners will be interested in following along on your journey. Do you tweet, LinkedIn, anything that's
I'm more of an Instagrammer.
Okay.
It's at Morgan F. Weber.
Okay.
With 1B. And I've even admittedly taken a little bit of time off from that in 2021.
Okay.
But all of our restaurants, you can go to agricolehospitality.com. It's nice and dialed in. You can see the restaurants. Each restaurant has its own personal Instagram and Facebook accounts. So follow along there.
That's great. Well, thanks for doing this, man. Super fascinating, and congratulations on your
Michael.
success. And
I really, Matt Whiter reached out to me. He's like, man, you got to do this podcast. He's great. So I really appreciate it. And man, truly some of the most interesting and deep dive questions that I have ever been asked.
Oh, fun. Well,
as it pertains to our industry. Yeah.
Super cool. Well, I'm totally fascinated, and you're great about it. So thanks for being here. Really appreciate it.
Thanks. All right. Well, have
Bye,
a great
everybody.
one. Thanks again. Bye, y'all.